Hello and welcome to the third part of my series on using college planning to increase your life insurance sales. In this video, we'll look at ways you can use college planning to sell higher premiums. Now, for this strategy to work, we want to target the middle to high income market, likely people that are already setting aside a sizable amount of money for their children's education, or that at least have the means to do so. We're going to help them move those dollars to a place that gives them flexibility, access, tax advantages, and no exposure to stock market losses. We can do that by paying premiums into a permanent cash value life insurance policy. This could be an index UL or a whole life product, even a return of premium term product. Now, why would we recommend a life insurance product? Well, let's first look at some of the alternatives out there and explore the advantages that life insurance brings to the table. So alternatively, your clients might put the money into a savings account or a CD at their local bank. Well, we know that they're not paying very much interest at all, and the interest they do earn is going to be taxed every year. So how can we gain more money? Well, maybe your clients want to put the money into a mutual fund or a stock. Well, those are securities instruments and could lose money with stock market losses. And what if the market is down when those children need to start paying their tuition? What are you going to do? On top of that, your clients have to pay taxes on the gains when those shares are sold. So we can solve some of those problems with an annuity. Now, we know that money taken out of annuities, or money in annuities I should say, is tax deferred. It's not taxed until you take the money out. However, if your clients happen to be under age 59 and a half when they withdraw those funds, they're going to be faced with an extra 10% penalty tax. Now, we don't want them to go through that. Another vehicle people often use for college planning is a Section 529 college savings plan. Now, these usually have mutual fund-like or 401k type accounts inside of them. The money in those is subject to loss if the market goes down. However, there is no tax on the gains if it's used for education. It must, however, be used for the education of the child whose name the plan is in, or a sibling or another blood relative. Well, what happens if that child doesn't need the money to go to college, or they don't go to college? Maybe they have a full ride scholarship or something else has happened and the money just isn't needed. Well, the parents are kind of locked into that. On top of that, there are some maximum contribution limits on those plans. So what can life insurance do to solve some of these problems? Well, first of all, we know that life insurance pays a death benefit. That is the primary reason people purchase life insurance. So if your clients are planning to set aside money for the college education of their children and they don't live long enough to do that like they had planned, the death benefit can step in and provide that money immediately. On top of that, assuming your clients do live to see their children go to college, the money inside of a life insurance policy accumulates tax-free and can also be distributed tax-free through loans. We need to make sure the policy is not a modified endowment contract. We also need to make sure that policy never lapses. But as long as those conditions are met, all of that money is distributed tax-free. Now, we're also not locked in as far as what we want to use the money for. If the child doesn't need that money for college, guess what? Mom and dad can save the money back and use it for retirement, a new car, a boat, a trip around the world, whatever they want to. We are also not faced with maximum contribution limits. People can put as much money as they want to into a life insurance policy, and the federal government isn't going to limit them in any way. Now, we also know that with our products here at Financial Brokerage, since we don't deal with securities, none of the money in those products is subject to market losses. Your clients cannot lose money if the stock market goes down. And best of all, using any form of permanent life insurance, the money inside there is excluded from the FAFSA calculations. The FAFSA is the report that parents and students have to fill out to determine the amount of money that they are required to pay as a family towards that child's education. Money inside of life insurance is essentially hidden from that report. Now, at Financial Brokerage, we usually look at index universal life to fund these plans, but we could also look at a whole life product, a return of premium, or even maybe a traditional universal life. Now, as I mentioned in the first video in this series, we don't want to forget about grandma and grandpa. Now, mom and dad might not have the funds, but maybe grandma and grandpa do. Do you have senior clients that are currently taking required minimum distributions? Do they need the money, or are those just extra funds they don't actually need to live on? Well, the next time you see them, ask them about the grandchildren they have pictured all over the walls of their home. I bet they would love to help them out. In fact, grandma and grandpa could certainly provide the funds for a permanent life insurance policy on mom and dad, or mom and dad, for the benefit of their grandchildren's education. So that's it. If you've been following along with all 3 videos, you now have 3 ways to use college planning to increase your life insurance sales. You can do that, 1, by selling more policies through foresters so that your clients have access to their college scholarships. 2, by selling higher face amounts just by asking some very simple questions of your clients. And 3, by selling higher premiums through a thorough college planning process leading to an indexed life or a whole life insurance sale. Let me know how I can assist you further with your next client contact.